Hi everyone, welcome to today's video. If you are an equity investor, I'm pretty sure you are under stress. Nifty has crashed over 13% since the beginning of the year, and S&P 500 has crashed over 20% since the beginning of the year. So what happened? Just a year ago, the market was so optimistic and the prices were going up and up as if there was no tomorrow. Now it is completely different. Let's find out in today's video why. If there is one word that could summarize all that is happening across the globe, especially in stock market, then it is inflation. For starters, inflation is the rate at which the prices of goods and services increase in an economy. As long as the inflation is within the target limit, for example, in India, if it is anywhere between 2 to 6%, it is considered to be benign and good for economy. On the other hand, if it crosses the tolerance limit of 6%, it is not good. It could potentially impact the growth of the economy. It could hurt the end consumers because they cannot spend more. They have to pay more for their goods and services. And it will impact the input cost of the company. As a result, it will reduce their profit margin. And overall, it will slow down the economy. So to tame the inflation, central banks across the globe has now started increasing the interest rate so that they can control the money supply in the economy and slow down the inflation. If raising interest rate is good for the economy, then why the stock market is in panic? To understand that, we need to first know how the companies are valued. Well, there are many ways to value a company, but the most popular one is called discounted cash flow method. According to it, the value of a company is dependent on its ability to create cash flow over a period of time. So it is summation of cash flow for the next 5 years. But it is not just the summation of cash flow, it is summation of discounted cash flow, hence the name discounted cash flow method. So what is a discounted cash flow? Well, the cash you have now is worth more than the cash you would have in the future, simply because if you have cash right now, you can invest in assets and could generate better returns than investing in 5 years from now with the cash you would have then. As a result, you will always have to discount the cash that you would have in the future to its present value based on certain rate. And what is that rate? That rate is usually the risk-free rate offered by certain economy. In India, it's usually the risk-free rate of GSEC bonds because the money that you lend to government, you're always going to get back. The risk-free return offered by GSEC bonds are also influenced by the interest rate raised by central government. And you can see in the formula that the risk-free return is in the denominator, and as a result, whenever it goes up, the present value of cash flow goes down and the value of the company goes down. So now with rising interest rate, all the investors are recalibrating the valuation of stocks they invested in based on the current interest rate. Sensing that valuation of some of their companies are now lower than they were, they would offload some of their portfolio to minimize the losses. Well, this is one of the reasons why stocks are in free fall, but we have many more. The second reason is whenever central banks raise the interest rate, the yields of government securities like GSEC bonds or treasuries go up, and they are considered to be risk-free assets. As a result, institutional investors like pension funds or insurance companies pull out money from risky assets like stock and move it into less risky assets like government sec or treasuries. And that's what happened when Fed raises the interest rate. Foreign institutional investors pull out the money from Indian stock market and move it to treasuries, and that brought down the stock market drastically. The third reason is whenever central banks raise the interest rate, companies will have to shell out more to service their loans. As a result, their profit margin takes a hit and hence their cash flow. And you know what happens when the cash flow goes down? The valuation gets impacted. Also, as an end user, I have to shell out more to pay back my EMI. That means I'm left with lesser money to buy goods and services, and that impacts the sales growth of companies and hence their cash flow and valuation. So one more reason why the stocks are in free fall could be because due to high interest rate, people may not be able to take out more loan to fund their initiatives like buying a home or buying a car. As a result, they liquidate their existing assets like stocks to fund their needs, and so you will see more people selling off stocks, and that bring down the stock market. Now we have seen the reasons why the stock market is in a free fall, but what one should do now? Well, if you are a long-term investor, you do not have to do anything, just sit through it, because the stock market has given always over 15% return in 15 to 20 years time period. On the other hand, if you have invested for a certain financial goal and that goal has just reached, then you better pull out the money provided you are not in loss. If you are in loss, wait for a few more months, and when the market has reached the bottom and started gaining back and your investment is no longer in red zone, then exit the market. Till then, just hold on to it. Well, these are my observations. If you want to make an informed decision, please consult your SEBI certified financial advisor before making any decisions. With this, we come to end of today's video. If you like today's content, please share it with your friends. Also, like, share, and subscribe to our channel. Thank you.